My name is Grant Seabourne, and I'm a certified financial planner at First Financial Trust.
Hi, I'm Brooks Hutchinson, Senior Vice President and a CPA here at First Financial Trust. And the reason I'm sitting here with you today is it is the wonderful time that we all look forward to, and that's tax filing time. This is the time of the year that we get a lot of questions around, hey, I forgot to do something last year, or what can I better plan for this year so that, we can lower the tax responsibilities that I have, because no one likes forking over all of their wealth over to the IRS. They want to keep as much of that as possible. So today we're going to go through a lot of common questions that have been submitted to us and kind of just have a dialogue about it all. So with that being said, Grant, I think you've got some of our initial questions to start us off. So go for it.
I do. We'll dive right in. So I think one of the more commonly misunderstood accounts is the health savings account.
Mm-hmm.
So can you visit with us a little bit about what an HSA is?
Yeah.
And some of the parameters around that account?
Mm-hmm. Yeah. So health savings account is a great vehicle. I call it the unicorn account. Okay. But it's only offered if you have a high deductible health plan. And the reason it's only offered if you have a high deductible health plan is because, the premiums that you're paying are a lot lower on a monthly basis, but your deductible is so much higher. So it's really meant for those people that think, I'm not going to have all that much in healthcare costs this year. So therefore I want to keep my premiums low. If I have to pay out of pocket for something, I'll pay out of pocket. But then you have this health savings account that you can contribute to. And the reason I call it a unicorn account is because you're getting a tax deduction when you make the contribution. You're able to then put that investment most of the time into an account that's going to earn some kind of interest, dividends, capital gains, just like a normal savings account would in the market. And then those interest, dividends, and capital gains are not taxed, very similar to like a qualified account like a 401k, IRA, or Roth IRA. And you're not paying taxes on that. But then the best part about it is, unlike all of our other accounts where we got the tax deduction on the front end, we think, oh, we got to pay taxes when we take the distribution. The health savings account, you don't have to do that so long as it's used for qualified medical expenses. So what a lot of people will do, there's kind of two ways that you can use those funds. One is whenever you have that unreimbursed medical expense, you can go take money out of your HSA, reimburse yourself because you had to pay out of pocket for it. Or what you can do is you can allow that money to continue to grow in that health savings account, keep your receipts for everything that you should have been reimbursed for, and then later on in retirement, use those receipts to take the money out of the HSA because there's not a time limit on whenever you can reimburse yourself. And if I have an account that's growing tax-free, interest-free, dividend-free, capital gain-free, and then those distributions are not going to be taxed, that's going to be a great account to possibly lever when I'm in retirement for distributions for other things. Now, not a lot of people, especially in the younger generation that are having kids and everything, have that luxury of saying, well, I'm going to contribute into this HSA and then not reimburse myself, because a lot of those expenses can be pretty high with how high the deductible is. So there's a great tool though for maybe later on in life, for you to have that flexibility. So health savings accounts are a great vehicle to take advantage of. And even, for my instances, I had a high deductible health plan at one point, and my wife had just given birth to our second child. And I wanted to make sure that I got that deduction. So what I did was I made a contribution to the HSA, and then just a few months later made that disbursement out. And by doing that, I made that contribution deductible and then my reimbursement non-taxable, instead of just saying, well, I'm going to cut a check directly out of my checking account to the healthcare provider. Well, now I've missed out on that deduction. So there's a lot of different tactics that can be used, and that's where a certified public accountant or a CFP could come in and really help you relegate how you need to do that.
Wow, I thought I was going to have to come in and bring in you summed it up really well. Yeah, it's the only account, I believe, that has the triple tax advantage of tax deduction, tax deferred growth, and tax-free distributions.
Yep.
If they're qualified.
It's a unicorn.
And you can, I believe you can make prior year contributions. So now, before the tax filing deadline, you could make a contribution for the prior year.
Yep. Well, so yes, you can do contributions for the prior year up until the tax filing deadline, or the date of payment of 4/15 of the next year. So good news for you people that had an HSA last year. You still have time to make that contribution up until next mid-month, but that's also the time that you have to pay your taxes. So still a little bit of time, but every year that you feel like you've forgotten to make that contribution, you have a little bit of a grace period afterwards. One of the confusion parts that get brought up at this point too is the flexible spending accounts. There's a thing called FSAs. Health savings accounts, as we've discussed, you can carry into perpetuity, keep those receipts, reimburse yourself at any given point, invest it. It's not going to be taxable. FSAs are a little bit different in that it is a use it or lose it account. So typically, if you're making those contributions through your payroll to get the tax deduction on the contributions, you have to use up those funds by the end of the year. Otherwise, they go away completely. So that's a really big caveat that I want to make sure we touch on. And then there's two types of FSAs that you can do as far as healthcare and dependent care. So very much like an HSA, the FSA could step in for the healthcare part as well. But then there's an added layer for the dependent care, such as if I'm paying for my child's preschool or private school or any kind of extracurricular activities, I'm going to be able to take a contribution out of my payroll, put it into an account, get the tax deduction, and then use those funds to help reimburse myself for those expenses. So where those were expenses for the healthcare and the child care were not tax deductible, I've made them tax deductible. Now they're subject to limitations on the contributions, and those are changing every single year with the IRS. But one of the key things to keep in mind is use it and lose it, FSA. Carries in perpetuity, HSA.
Which I'm glad you said that. Don't let the misperception of, if you think the HSA is a use it or lose it account and you don't make a contribution because you think you may lose it, don't let that be a deterrent from using that vehicle for the full impact of tax benefits. Yeah, I'm glad that you pointed that out.
Well, and a lot of people think, okay, if I worked for this employer and I had a health savings account and now I'm moving to a different employer, but I'm not going to be able to get a high deductible plan, therefore I'm not going to have an HSA. Now I've lost the health savings account. And that's not true. There's several different institutions that you could open a health savings account at and transfer that account over and keep under your management. Now, how the contributions work from that point forward is going to change based on how you elect for your health care and what's offered there. But you can transfer it just like you would if you were going to move an IRA or a 401k or a brokerage account from one institution to another.
Yeah. Love it. Great tool. And I really liked your point too about, if you have the ability to cash flow your medical expenses, letting those funds accumulate in the HSA tax deferred, use them in retirement. We all know medical expenses in retirement are going to be high.
Yeah.
So use it as a savings vehicle for those specific expenses.
Yeah, and I typically see that for my high income earners. They're able to pay out of pocket for a lot of those expenses and they don't need that reimbursement. And they'd much rather see that money growing the way it needs to grow and then know that they're going to be eventually able to pull that money out tax free.
Yeah.
But with the cost of healthcare the way it's gone, it's unfortunately gotten to a point that it's not a very common practice anymore because most people need that reimbursement because of how high deductibles have gotten and how costly a lot of these procedures have gotten.
Absolutely. Well, we talked about making a prior year contribution in your HSA. Let's say that you have a traditional IRA and similar, you forgot last year, you didn't get around to it by 12/31. Can you make a prior year contribution to an IRA?
You can. Yep. So same thing, health savings account, IRA, Roth IRA, you have up until the 4/15 deadline to make a prior year contribution. Now you want to make sure, obviously if you're working with someone at trust, we'll know if you wanted to make it for the 25 or 26 contribution, but for someone that's got their own IRA out there that they're making that contribution into that account, you'll want to make sure and notate what year it's for and not just blindly say, oh, I'm making a contribution. Make sure in that notation it's for 25 or 26 because
you could
double up and say, okay, well, I'm making a contribution now for 25 and in 6 months, I'm going to make one for 26. But if that one that you're making right now is not labeled correctly, then you could be over contributing to that. But you do have the flexibility to make two contributions in the same year for different years.
Right. And be cognizant of those limits can change.
Mm-hmm.
don't contribute 7,000
Yeah.
to your prior year.
Yeah.
And the limit last year was maybe 6,000.
The IRS likes to keep you on your toes with how little that sometimes they change it, sometimes it stays the same, and sometimes it's $500 they change or $1,000. It doesn't make any sense one way or another. I will say from a self-employed standpoint, or for someone that's not a W-2 employee and their cash flows are up and down and they never know what they've truly earned in the year, that's where a lot of people will kick the contribution until the next year before the tax filing deadline to know if they're going to be in the limitations.
That makes sense.
Because, yes, you can contribute to a traditional IRA. Yes, you can contribute to a Roth IRA, but there are very stringent limits on income.
Right.
So if I'm in a situation where I want to get a tax deduction and put my money into a traditional IRA, I'm able to do that. However, if I'm above a certain income on my joint or single tax return, I can't contribute to that traditional IRA and get a tax deduction. I can make a contribution,
Right.
but that doesn't necessarily mean I'm going to qualify for the deduction. Same time with the Roth IRA, I can make a contribution up to a certain income limit. Otherwise, I can't contribute at all. So there's a lot of different tactics that we use in that situation. I mean, obviously, if you have a 401k employer provider, there's some situations where we could reallocate some of the deferrals that you're doing in the 401k because you're ineligible for the traditional or Roth IRA. But let's say you're not covered by an employer sponsored plan and you still want to have those contributions into a Roth account. Well, if I'm going to contribute into a traditional IRA and I'm not going to get the tax deduction because I make too much money, and I can't contribute to a Roth IRA because I make too much money, there's a thing called the backdoor Roth contribution. So essentially what you're doing in that standpoint is you're contributing into the traditional IRA, you're not getting the tax deduction, and you're converting that basis over to the Roth IRA. How that's a loophole still, I have no idea. I could not tell you. But as long as it is something we can do, we like to take advantage of it.
But one thing I'll add to be careful of, and maybe you were about to say yes, but if you have a lot of other pre-tax dollars sitting in a traditional IRA,
you hit the nail on the head.
Go ahead.
Yeah, no, you hit the nail on the head. That's exactly where I was going is, yes, you can do that. But if you have a bunch of pre-tax IRAs, that conversion actually gets taxed, or part of that conversion actually gets taxed.
Yeah.
So for a lot of my individuals that I'm doing these tactics for, what we're doing is we're rolling their pre-tax IRAs into their 401k so that it clears out all of their pre-tax IRA money.
That's right. 401k dollars aren't.
Right. 401k dollars are not included in that conversion application. So that's a tactic that we like to use. It's kind of the last resort that I do because the 401k is another account that we really haven't talked about. And that's such a great vehicle because a lot of 401ks today offer pre-tax and Roth deferrals. So if someone's wanting to get a lot of Roth money in place and they're like, well, I want to do this backdoor Roth contribution, but they're not taking advantage of that Roth deferral that isn't subject to income limitations,
Right.
and has actually got a lot higher amount of ability to put in other than the 7,000 to 8,000 that's today. We want to go exploit that first.
Right.
And then if for any reason they're wanting to get even more into Roth, then we'll start talking about doing this kind of tactic. But there's usually always an option before you have to go do all these steps because it can get a little bit messy when you're trying to do the cleanup. And at the end of the day, all you're getting is another, 7,000 to 8,000 in a Roth contribution. It's just a lot more legwork.
Right. I'm glad you highlighted IRAs. You have to be cognizant of the income limitations before you make a contribution. 401ks, there are no income phase outs. So you can
Correct.
not yet. That's a great distinction.
Take advantage of it when you can. It's a great vehicle to get those dollar amounts, and going back to what we've talked about in prior videos with the bucketing strategy of the different environments to make sure that we're not putting everything into a pre-tax environment, but having a good, healthy balance.
Yeah, absolutely. As we're talking about pre-tax, traditional versus Roth, can you talk a little bit about how someone would navigate the decision of whether to make contributions in the traditional or pre-tax bucket versus the Roth bucket?
Yeah. So it's all going to come down to your tax rate. I mean, I've got plenty of people that doesn't matter their tax rate. They want to be in a certain environment. But if from a mathematical standpoint, when you're in the higher tax brackets, you're typically wanting that pre-tax contribution because you're going to get that tax deduction at the higher tax rate. Whereas if you're, younger and you're in the lowest tax brackets, you're probably going to see, that's a great time to utilize the Roth contribution. Now, you're not getting your tax deduction at the lower tax rate, but you're also allowing that money to grow tax-free for the rest of your life. And eventually, whenever you do get to those higher income tax brackets and you want to switch over to pre-tax, now you've already got a pretty good pile of Roth assets that are accumulating. Now, that doesn't mean that I don't still have people in low tax brackets that are contributing to their to the pre-tax. And that doesn't mean that I don't have high income earners that aren't still contributing to the Roth. Because when you think about the concept of a 401k, you have the deferral component that you can depict between if you want to do pre-tax and Roth.
Right.
But then you've also got to count in the match, the safe harbor, the profit sharing, whatever your company's matching you, that's all going to be already labeled pre-tax. So if I'm contributing on one end for my deferrals and I'm getting another side of the equation that's already going to be pre-tax, I don't have an option on that one. That's going to be a great way for you to extrapolate on what is my balance between pre-tax and Roth going to be, because if I go and switch those deferrals all to pre-tax, now every single contribution that's going in that account every single year is pre-tax.
Yeah. Yeah, that's you explained the purpose. So it sounds like, saying it back to you, you would want to apply the tax advantage when you're in the highest tax bracket. So
Typically, yes.
Yeah, if you're in a higher tax bracket now than you anticipate you will be later, you would do pre-tax or traditional with the tax advantage while you're in the higher bracket.
Correct.
If you anticipate you're in a lower bracket now, would be in a higher bracket in retirement, then you would do the Roth to, again, apply the tax advantage at the time you're in the highest bracket. And it's really about timing more than if you were in the same tax bracket, it wouldn't make a difference either way.
No.
So it's really about timing the differences in tax brackets.
Yeah. And it's always the conversation that we have to talk about with everyone that comes in, is the fact that we don't have that crystal ball of knowing what your tax rate's going to be in retirement, just like we don't know what the market's going to do. That's a huge calculation. I mean, it goes back to everything that we talk about when we're doing financial advising, even with Social Security. What are Social Security benefits going to be around? I don't know. What are my tax rates going to be in retirement? I don't know. How long am I going to live? I don't know. But all we can do as advisors in anything from tax planning to investment planning is just kind of come up with what makes the most sense for the client at that time. So one of the biggest caveats I make whenever we're giving this kind of advice to people is it's not a one size fits all. Right. Like, these are all great tax strategies for an individual to use, but that doesn't mean that it's applicable to every single person we're talking to, because everyone's situation is so different.
Right. And back to the traditional pre-tax versus Roth, you make plans based on the information you have today, you adapt, and that's all you can do is make the best plan with the information that you have today. And like you said, if you can end up in a place where you have hedged your risks either way with tax diversification, then everything will probably be okay.
Well, it's a year by year decision, especially for our self-employed individuals or contract workers, that their income's flowing up and down. I mean, just because you did something in 25 doesn't mean that that's the best decision for 26. And just because it was the best decision for 26 doesn't mean it's something that we need to look at for 27. We'll always take it into consideration, but we're always wanting to make sure that it's going to be maximizing the tax efficiencies of the portfolio or the individual, while at the same time it's meeting up with their needs for distribution purposes when they hit retirement.
Absolutely. Well, let's transition a little bit to, we've talked about delineating between traditional and Roth. We've talked about kind of how to lower, your tax liability this year by making, prior year contributions. But let's fast forward to someone who maybe, is older. Maybe, you're looking at early 70s. You started your required minimum distribution from your IRA or your rollover 401k. Talk to us a little bit about, maybe it's your first year to take a required minimum distribution. you've been doing charitable giving most of your life. You have some cash sitting in a savings account that you have earmarked to get to charity. It's your first year where you're legally required to take that money, your RMD, out of your IRA. Is there a better way than taking your RMD and then making a charitable donation from your savings account?
Yes. I think the answer is yes. No, the IRS allows when the IRS rolls out a rule, it's to either disincentivize someone to do something or incentivize someone to do something. And this would be a case of incentivizing people to be charitable. Now, if you're not charitable beforehand and now you're wanting to be charitable just to not pay the taxes on it, that's kind of a balance that you need to talk through. But if you've always been a charitable person in nature, when you hit the age of 70 and a half, you're able to make direct contributions out of your pre-tax IRAs to the charity of your choice, as long as it's a 501c3 organization. And what that's going to do is that's going to take every single dollar for dollar distribution out of that pre-tax environment and make it non-taxable. Whereas before it was taxable. Now it's 100% non-taxable.
Ordinary income tax.
Yes, or at ordinary income tax brackets. Yeah. Now you're required to make distributions to 73 up until 2033, at which point it goes up to 75. Mm-hmm. So basically anyone born, 1960 and after is going to be required to take distributions at 75. Anyone 1959 and before is going to be 73. So there's a little bit of a weird window in saying, okay, between 70 and a half and 73 or 75, I don't have to take RMDs, but I'm eligible to start giving out of my IRA to my charitable designations. But when I hit my RMD age, I have to take those distributions out. Right. I have to recognize the ordinary income tax rates that are going to be associated with that. Therefore, the taxes that are going to have to be paid. Well, if I'm giving charitably out of my savings accounts, well, I'm probably having to sell something that I'm paying a capital gains tax on, or it's been sitting in a savings account for a rainy day, sending that to the charitable organization. And then now I've got this IRA distribution that comes into play. And now I can start leveraging that so that if my first year, my RMD is $40,000 and I'm giving charitably $20,000, mm-hmm. Now I'm not paying ordinary income taxes on 40, I'm paying income taxes on 20.
Right.
Or maybe you want to be charitable with the whole thing, or maybe 5,000 of it. But it's a dollar for dollar reduction. And that is a huge, significant benefit to our individuals that are in RMD status, because if you've been charitable all this time, especially with the Trump tax cuts that happened back in 2018, they raised the standard deduction so high that even though everyone was saying, give your charitable contributions, it's tax deductible. Probably, I mean, yes, on paper it's tax deductible, but on your tax return, it's not, because the standard deduction is so high and the SALT tax was so limited that you would have been having to give, tens of thousands of dollars to charity to be able to realize that deduction. Whereas now, because those limitations are going away with those QCDs, every dollar for dollar that I give to a charity is a reduction of my income.
Yeah, essentially, I can't think of a scenario in which it would be better to make a gift of cash and take a deduction than it would be to use your RMD, assuming it's within the limitation.
Right.
Which is an important thing to be aware of, that if your RMD is $200,000, you can't give the whole thing away. Mm-mm. So it's important, just check with your CPA each year, because that amount historically has changed.
Right.
There is a limitation to what you can donate charitably out of the IRA.
And then that's whenever you would mix it in with some other tactics, donor advised funds that you could give a full year contribution to, highly appreciated stock. I mean, there's all kinds of levers and buttons that we can push to get you to the optimal position. But it's a huge, huge benefit. And I see QCDs, and I'm seeing this a lot with my clients that aren't 73 or 75. Right, well, why would I give charitably out of my IRA at 71 if I'm not required to make a distribution? Right. Well, in my mind, yes, okay, we're not required to take a distribution, but you're going to be charitable this year, so we might as well take it out of your IRA, because that IRA is just a future big IOU to the federal government. So the more money that we can take out of that pre-tax IRA rather than eating through their more tax-preferred environments, the better, and the lesser that RMD is going to be when they get to be 73 or 75.
Yeah. Yeah. I think there's a pull and tug there between I want to benefit from as much tax deferred growth as long as possible. But I think I agree with you at that point. You're so close to the R&D age anyway that, and if you're going to be getting charitably anyway, getting that money out of that taxable and that environment where it would be taxed as ordinary income, getting it out, going ahead and allocating it to charity. I think you're close enough to that R&D age that makes sense. And then the cash that you had on hand or the investments in the taxable account, you can keep those invested and benefit from lower taxes on capital gains as those appreciate.
Yeah, exactly. Exactly.
Well, let's talk. There were a few changes, a few legislative changes that came into play last year, some of which were effective last year, some of which will be effective this year. But one was a change to the state and local tax deduction, the SALT tax deduction. Can you talk a little bit about just what changed and what might you need to think about?
Well, for all of us Texas folk, that don't have state income taxes, it's going to be a huge benefit for those that have really high property taxes, because they're going to be able to, before it was a $10,000 cap on those state and local taxes that you could take on your itemized deductions. That's now been raised up to 40. And unless you have a huge estate that has got huge property taxes associated with it, you're going to get a large benefit from those property taxes now being raised up so much higher. That's what really crippled a lot of people from being able to itemize their deductions versus the standard deduction, because of how much they were being limited on their state income taxes. I mean, if you think about somebody that lives in Pennsylvania, New York, California, that's paying exorbitant, not only property taxes, but state income taxes, local taxes. I mean, there were some people I know that were paying hundreds of thousands of dollars in those taxes, and they, for the longest time, were able to write all those off through their Schedule A itemized deductions. But when you go in and you throw a $10,000 cap, I mean, your knees kind of get cut out from underneath you. So it's not a huge increase. It's going to be super beneficial for Texas. It's going to be super beneficial for those states that don't have state income tax, Texas, Florida, I think Nevada. But for those states that have the state income taxes, it's still going to be a pretty crippling effect. But it's going to move the needle into how many people are going to be able to start utilizing their charitable giving again, because now they're bumping up above the standard deduction, whereas before, it's like, yeah, we're giving charitably, and yeah, we're paying property taxes, but none of it matters because of how high the standard deduction came.
Yeah. So a good takeaway would be, whereas, if last year you took the standard deduction, maybe reassessed this year with the higher SALT deduction.
Yes.
It may be more advantageous for you to itemize now than like in prior years.
Correct. Yeah.
Another change that came through, it was highly anticipated. There was a lot of uncertainty around, will Social Security benefits be taxable or not moving forward? And there was a change for people that would fall into that age bracket, but it did not result in Social Security benefits necessarily being excluded from tax. Can you talk about the legislative changes that played out as it relates to that area?
Yeah, so you're getting a little bit of a higher deduction. Anyone that's 65 or above, you're getting a little bit of a higher deduction. It's not going to move the needle, though, a lot. But you also have to remember that the Social Security, I don't know what we're going to do with that. There's significant funding challenges when it comes to Social Security. So, whenever they were talking about taking off taxing Social Security completely, I don't know how you ever can get something through legislation that's going to do that. I know that people that are receiving Social Security are like, I've already paid the taxes on this before. Why am I paying taxes on it again? So there's all these challenges that have come in with the Social Security of, how is it going to be funded? And there's no clear answer on how that's going to be done. So there's a lot of incentives that I think the administration is trying to push through in order to lessen the tax effects of it. But it's probably not in line with what our Social Security earners were hoping for. It is going to help, but it's not going to help in a significant way like most people would expect.
Yeah.
Or what are your thoughts? I'd love to know your thoughts on that.
Yeah, I mean, and I think it's important to say it's dependent on the portion of your Social Security benefit that's taxable is dependent on your total income picture. So there are some individuals who have a lower percentage of their benefit taxed, and some have a higher percentage of the benefit taxed. And I agree. I think that the recent legislation fell short of the expectation of tax-free benefits. That I agree with you. That may have been a stretch to think that that would materialize. I believe the legislation included an additional $6,000 deduction for those over 65 or older. So I agree with what you said. It's good. Every little bit is helpful. It's not necessarily going to be needle moving money. But I'm sure a lot of seniors out there are appreciative. That's a per person deduction. So
that's better than what it was.
Better than what it was. That's right.
But it is still a $6,000, it's a $6,000 deduction, not a credit. So you're having to tax affect that $6,000. So if I'm in the 20% tax bracket, that's going to save me $1,500, $1,800 in taxes roughly. So a little bit of a needle mover, but it's going to be interesting to see what other implementations they're going to have to put into place to keep the Social Security program even alive.
Yeah. That's luckily above our pay grade.
Luckily, it's a while away for us, or maybe it's a disadvantage. I'm not sure yet.
Yeah. Well, one final change, and then this is by no means, obviously, this conversation is not encompassing of all of the legislative changes that went through last year. But another change that I thought was interesting, and that I think some of our clients thought was interesting, was talking about going back to some of the tax framework around charitable giving. There have always been ceilings of maximums in place. You can historically, throughout recent history, give up to 30% or 60% of your adjusted gross income. And whether it's 30 or 60 depends on
what kind of property you're giving.
In kind, was it cash? So talk a little bit about the recent, that is, from my understanding, still in place. I don't believe any changes were enacted as it relates to the maximum of the ceilings, but have you read up on any of the changes that did come through?
Not a lot of the changes. I mean, it's all going to be there's obviously going to be a ceiling and a floor, and depending on if you're giving cash or property or stock, or it's all going to be a given limitation. And there's all these calculations that go into these dang limitations, because you're talking about unreimbursed medical, got to be above 7.5% AGI. If your interest deduction on a mortgage of $750,000 or more, you're only going to get mortgage interest on the $750,000 or below. SALT cap is going from 10 to 40. Charitable giving now has got the floor limitation of 30% that you've got to be above, but you can't go above 50%, and anything in excess gets carried over to the next year. So I think the point being is I'm not going to go, I guess, particularly into all the dynamics of what changed so much, as it is worth a relook for those people, especially with all these changes, because there's a lot more opportunity now to itemize, but there's still certain limitations that will come into play. So don't just think, oh, I'm going to give this amount of money or this property to this charitable organization, and that's going to reduce my tax liability 100%. No, there's plenty of things that the IRS saw and put the limitations in place for this exact reason. And that's why it's even more important to have a CPA or a CFP looking at this and advising on what the best solution is, because sometimes it's a lot of my people that we have with cash donations or stock donations, because of the limitations in place, we say, hey, it's not going to be strategic for us to do all of this year. And we realize you want to give X amount, but especially when it's getting to be year end, we're just going to say, hey, let's do, a quarter of it this year and then the other 75% next year, or we'll do 50% this year and the other 50% next year, because that's going to maximize your tax deductions across 2 years, rather than try to find it all in one.
Yeah, that's a great point. Yeah, I think it's not getting any less complicated as we go through.
No.
I thought the floor now, I believe anything, essentially you have to charitably give more than 0.5% of your AGI, your adjusted gross income,
Mm-hmm.
in order to get any charitable benefit
Right.
tax standpoint. So I hadn't seen, at least in my professional career, I haven't seen a floor on charitable. I thought that was an interesting change to the law. But you can see there are things that are moving in the right direction, like the ability to take the standard deduction, but you can still deduct. Normally, you would have to itemize the deduction charitably after that, but to be able to, that was one of the recent changes.
They give you a small, regardless if, it's not much. It's not much, but it is something, maybe it's your tax preparation bill, that you're saving in taxes.
Oh, there you go.
That's all. That's rationalizations, and I saved my tax prep bill in a charitable contribution because I took the standard, but the IRS allowed me another $1,000 in charitable deductions regardless.
Which it's worth it. It's worth it to pay certified.
Every little bit counts, man. Every little bit counts.
Very good. Well, Brooks, thank you for the time. Enjoyed talking through this with you.
Yeah, this has been great. And if you have any questions, please feel free to reach out to us. We're all about catering to everybody's individual needs. This time of year gets hectic. Everybody's frenzy trying to get all their tax documents together. I know that I'm doing that right now. And I'm a CPA. Like, it's not always fun,
This was coming.
Every year, like Christmas. So if you have any questions, please feel free to give Grant or I a call.